Okay, so this evening we're going to be talking about market structure, all right? Market structure analysis and basically understanding market structure, okay? So market structure is the basis basically of understanding how the market operates, because now when you come into the market, into the chart, you will understand that every candle you see on the chart is giving you data, is giving you information that you can use to make decision for the future, for a future trade. So whether the candle is a very long candle, or the candle is a green candle, or the candle is a red candle, or the candle has a long wick or a short wick, or a green candle is followed by a red one, or a red one is followed by a green one, right? All of that is giving you cumulatively, is giving you information, data that you can use to analyze the market for a future trade that you want to take. So all of that put together is what we call market structure, right? So when you begin to study the market, you begin to follow patterns. You start to see patterns. You start to see certain patterns forming from day to day, from hour to hour, from month to month, week to week, day to day. You start to see certain patterns that give you an idea of what the market is likely to do tomorrow. Otherwise, there will be no need, there will be no way for us to actually trade. There would be no way for us to actually trade, except that what's happening in the chart already, on the chart already, is already giving us hints, giving us information, giving us data that we can use to place our trades in the future. Okay, so that's basically what we're going to be going through on this in this class tonight. When we talk about in last class, we talked about trend identification. Then we talked about support and supply and demand. All of that stems from market structure. All of that comes from market structure. And then putting it all together and using it in a cohesive way to make trading decisions is basically what we call market structure analysis. Okay, so it's very, very interesting. I can tell you this, guys, when I understood market structure, that was when I actually got to understand trading, when I personally understood market structure. Right? So that's why when I talk about market structure, I talk about this so much with a lot of experience. I talk about it with knowing what understanding market structure did for my personal trading and my understanding of the market, right? So that's what we're going to go. We're going to go into the chart right now where I can write some things and I can show you some things, and then we will take it off from there. And also we're going to be going into the chart to also use what we've seen, what we are going to go through in this class to basically do market structure analysis. Okay, at least start market structure analysis. Let me put it that way. All right, so let's get started. So market structure analysis in Forex. Market structure is basically the study of price movement and behavior. You can't hear me. If you can hear me, please put a 1 in the chat. If you can hear me, put a 1 in the chat. If you can hear me, put a 1 in the chat. 1. Let me see if who can hear me. Please, if you can hear me, put a 1 in the chat. 1. 1, just 1. I want to know who can hear me if I need to do something, if it's from my side. Put a 1 in the chat, please, if you can hear me, or you can unmute yourself and tell me you can hear me. All right, I just want to be sure that you can hear me, guys. Can anybody hear me? Please let me know if you can hear me so that I don't just continue while you're not following.
We can hear you, sir.
You can hear me, okay.
Yes, who else I can hear you.
Okay, please, who else can hear me? That's one person who can hear me. Is there anybody else who can hear me? Just put a 1 in the chat so that I will know you can hear me. So if Emmanuel, you said you can't hear me, can you check your connection? Can you see if you connected via, because when you come in, you're meant to connect It show you where to dial and connect, right? So please check if you have connected there. And also, if you cannot hear me, if you are not able to hear me, you can't hear me, please let me know. Please let me know, all right? Okay, so let's proceed. Now, if you can't hear me, please let me know so that I'll calm down and sort it out before I continue. So market structure is the study of price movement and behavior of currency pairs in the forex markets. Okay, good. So market structure is the study of price movement and behavior of currency pairs in the forex market. Okay, so you can take note of these things that I have on the screen here. It helps traders identify trends, levels of support and resistance, and market conditions. So market structure is basically you looking into the market to identify trends. The concept of market structure helps you identify trends, right? Levels of support and resistance, as well as market conditions, other market conditions, right? So now when we talk about support and resistance, we also, some people know it as supply and demand. That's basically the same thing. Support and resistance is supply and demand, is the same thing, right? Resistance, support is supply. Resistance is demand. No, resistance is supply. Support is demand. Resistance is supply. Support is demand. Okay. So now the market structure is influenced by various factors such as economic data release, geopolitical events, central bank policies. Okay, so now when normally when you're going through the chart, there are many things that causes the formation of a candle. There's many things that causes the formation of a structure. When you hear structure, all right, a structure in the market, there are several things that forms this structure, makes the formation of a structure happen in the market, right? So all of that is what we're talking about when we say economic data release and all that, geopolitical events, central bank policies. For example, now when you go to the chart right now, go to Euro USD, you see what Euro USD is doing. Go to USD JPY, you see what USD JPY is doing currently. Go to Euro JPY, go to DXY, which is the dollar index, go to gold right now, go to NASDAQ right now. You will see what the market is doing. But watch this, excuse me. Watch this. Tomorrow, the Fed is going to be releasing a very important data. This is what we call FOMC. Okay, FOMC is the Federal Open Market Committee meeting. This meeting happens somewhere around 8 times a year. The first one is in February. Next one is in March. Then they skip April. Then the next one is going to be in May. It continues like that. It happens 8 times a year. Now, when that happens, right, when that news event is released tomorrow evening by 8 p.m. Nigerian time or GMT +1, that news is going to disrupt the market. In fact, before that happens tomorrow, there are several other events that will happen. On the economic calendar, from the economic calendar we posted in the chat yesterday, if you go through, you will see what I'm saying. Okay, there's Joe's job reports. There are lots of things. There's ADP non-farm payroll. All of that are coming before the FOMC meeting tomorrow. Now, when those news events start coming out, what will happen is that the market will start to adjust. There will be massive buy movements or sell movements. And whenever a massive buy movement or sell movement happens, a new structure is formed. A previous structure is broken, a new structure is formed. A previous structure is broken, a new structure is formed. Now, before a particular news event is released, if you are in the market and you are about to trade, there is a way you will trade. There is a supply and demand zone that you are going to be watching. In other words, a support and resistance zone you will be watching. before a major news event comes out. You'll be like, okay, if price gets to this area, I'm going to trade here. If price gets to this point, I'm going to trade here. If price gets here, I'll buy here. If price gets here, I'll sell here. That's what you were planning to do, or that's what you will be planning to do in a regular market. But what happens when you know that there's a news event coming? And when that news event happens, and the market is affected heavily, that news event is a surprising event in the market, which means it's an economic news release, and it affects the market in a very significant way. What will happen? That structure you were support where you were looking to buy before, price will break through it. Price can break through it as if it does not even exist. Price will break through it as if it doesn't even exist. What has happened? When price breaks that structure, what happens? A new structure is going to be formed. That's why we say that market structure is influenced by economic news release, geopolitical events, and central banks. Tomorrow, what we have is basically central bank and then some economic news releases, right? So that's what you need to be watching out and saying, okay, now that we're expecting a news release or a major economic news release, what new structures is the market going to be forming? Sometimes you can see that price will break out of a particular structure, and then the price, normally when price breaks out of a structure, price will usually retest that structure. In other words, come back and test that structure. Come back to that structure just to show you that, okay, there's actually a breakout of this structure. And then before it starts to head either for a buy or a sell, right? But now there's in some cases a price moves so massively that that structure is broken and it's not tested. Then you will realize that sometime in the future, maybe about a month later or 2 months later, something happens in the market that affects the market in a massive way. Price comes again to that area that it left 2 months ago. You see, so the whole market works together, but these major events that move the market, they have a way of recalibrating the markets, you see, and creating market structures, new market structure, as it were, every time. Okay, so it involves identifying trend direction, up or down or sideways. We talked about trend the other day. We said we have uptrend, we have downtrend, and when we have a sideways trend, otherwise known as a ranging market. Okay, so whenever a trend, whenever you're identifying or studying a trend, you are looking at what is the direction of the market based on the formations in the market, based on the structure that's forming in the market. What is this market doing? Is it in an uptrend? Is it in a downtrend? Is it in a sideways trend? It's market structure analysis that tells you all that. It's market structure analysis that defines all of that for you, and you are able to understand what trend you are. If you're in an uptrend, you're looking to buy, right? If you're in a downtrend, you're looking significantly to sell. And if you're in a sideways trend, the best thing to do in a sideways trend is basically pause and wait. Now, there could be an opportunity, there will be short-term opportunities within a sideways trend, but the best way to trade a sideways trend is to wait for a breakout. Okay, so you see how that you are doing market structure analysis, you are identifying what's going on in the market, and also because you can identify what's going on in the market, you are able to now take decisions as to what to do. How do you enter into a market and know that price is most likely going to be buying to a certain level? Because you can identify, you can come into the market and you can see an uptrend. An uptrend is what is telling you that price is likely going to be moving higher. Now, when you come into the market, you see a downtrend. A downtrend is telling you price is going to be coming down. And then a sideways trend is telling you price is likely going to go in either direction. Yes, it's recording. It's recording. So price is telling, a sideways trend is telling you that price is likely to go in either direction, up or down. So at that point, what you do is that you identify, when you identify a sideways trend, at the time you are holding or you are waiting and you tell yourself, okay, I'm going to wait for a breakout of this for me to trade. Somebody else will be trading. Somebody else will be entering a buy and a sell. The person may be making little profit or they may be losing money. But why did you wait? You waited because the market structure analysis showed you that you are in a sideways trend, and therefore you should probably wait, right? So now, recognizing key support and resistance level, where buying and selling pressure can be significant. That's another thing market structure does for you. Helps you recognize key support and resistance levels where buying pressure can be significant. You will see certain things. Let's say you're there's a breakout of structure in a certain place. Then you use Fibonacci and you see that price is lining up in a certain area. All of this will go into the chart to look at them, right? So you see that price is lining up in a certain area. You can very well predict that price is going to make a significant move. You can draw it and say, hey, price is going to do 100 pips from here. It's going to do 200 pips from here, right? You see that happen all the time. You see that, for example, you're watching probably some YouTube traders that will tell you, okay, I'm marking price to do 200, 300 pips. How does the person know? Most of the time you see it play out. How did it play out? It played out because they can analyze the market, look into it and say, oh, this is where I'm expecting price to get to. And some of the analysis will do the same thing. You see, this is where we are expecting price to get to. Why? Because structure tells us the past in the market. Like I said earlier when we're starting, I said every candle you see, every formation you see in the market is basically telling you, is giving you information, is giving you data that you can then use for future market analysis. Okay, that you can use to take your trades in the future. How far, if you're entering a sell trade, how far can this sell come to? How far will it come before it eventually starts reversing again? We know that market goes up or down. It doesn't go up, down perpetually. It doesn't go up perpetually. Now, if you look at the dollar index and consequently the USD JPY, USD CAD, sometime last year from around March all the way to October, USD pairs were just buying. In fact, I was telling someone, I said, you could just wake up in the market and just buy USD JPY or USD CAD, just buy, especially USD CAD. You could just buy then and not even bother about where you are buying. Just place buy and go away. And come back after 2 months, you will see that you are making massive profit. That was how it was. But it didn't remain like that. In November, when the inflation numbers came out, the market collapsed. USD JPY, USD pairs collapsed, USD index collapsed. And all that while it has been dropping all that while till now. You see? So the market moves in cycles like that. So how do you know how far it's going to go when you do your analysis? How far upwards? How do you know how far it's going to go downwards? Market structure tells you. You see, this is why market structure is basically everything. Okay, let me not say everything. Significantly, what you need to know. If you understand market structure and how to use it very properly, you do not need to know everything. You don't need to know. You may not need to know too much more than that to be profitable, to be consistently making money from the market. You see, sometimes people ask me, oh, what about Elliott Wave? What about this? What about that? What about so many different things in the market? What about not Fibonacci? What about, so many things they ask. Ichimoku, what kind of things, right? What you need to understand is that when you know market structure, you understand how the market is flowing, the flow of the market. That's what market structure is, the flow of the market. When you understand the flow of the market, you don't need many other tools, because the truth is that the market is already telling you what it's going to do. Yes, you will not be right 100% of the time. Nobody is. The market is like real life. You can wake up today and rain starts falling in the morning, right? That's something you can't bank on, right? You can wake up today and there's electricity issue or something happened, there are so many things you can't really control, but there are some things you can control. That's the reason why you can't predict the market 100% of the time. But then when you know how the market works, then you know that whatever, if a trade, if you analyze a chart and it didn't go your way at that time, you know that it's probably just a market behavior, or maybe your perspective at that time based on some kind of condition, you didn't pick it out the right way at that time. but you know that you are going to be right 70% of the time. So you are not bothered. All right. When you add your risk to reward ratio and your money management to that, you are significantly profitable. Right? So understanding market structure, short-term, long-term trends, market volatility, and momentum. All of that is pictured for you in market structure, right? Short-term, long-term trends. So when you go on the huge time frame or a longer time frame, you go on the monthly chart, you go on the weekly chart, you will begin to see how far a certain move is going to go, is likely to go. You start to see, okay, this buy is likely to continue for a very long time, or this sell is likely to continue for a very long time, or maybe price is at a certain structure where it has been buying. Now you know that, hey, where price is now, price is likely going to fall from there by 300 pips, by 400 pips, by 500 pips. There are times when you look at certain pairs, you just see that they are at more like an inflection point at that time. You know that, oh, this thing is going to collapse from here, it's going to sell from here, or it's going to buy from here, and it's going to do a huge amount of pips at that time. How do you know that? You know that because you're looking at short-term and long-term trends. You know, there are huge institutional traders that trade from long-term perspective. They are looking at what will the dollar do this year. They are not looking at what the dollar is doing today or this week. No, they are looking at what will the dollar do this year. Is the dollar going to fall this year? Is the dollar likely to rise this year? And then when you are looking at that, there are so many different factors you are putting in place in order to be able to determine that kind of move, right? So you're not looking at one thing. You're looking at economic data. You're looking at the market structure. You're looking at the market. You're looking at the conditions around the market. You're looking at external and internal things, basically. But then, even after you've determined all that, and you decided, for example, that the market is going to sell, you are still going to come back to market structure to tell you how far this sell is likely to go. You see, how far is this sell likely to go on a long-term basis, if you want to trade long-term, or on a short-term basis, if you're trading short-term. Okay, so short-term and long-term trends, market volatility, and momentum, right? So you can see through the kind of candles that are formed, which is still market structure analysis, you are able to see this is like price has started moving. For example, when you come into the market early in the morning, maybe around when the New York session closes, or until when the Asian session closes, like in Nigeria, that time is usually between 11 p.m. and sometime around 1 or 2 a.m. Except something happens at that time, you will not see massive moves in pairs like Euro USD or gold, you know, or GBP USD. You may not find very massive moves at that time, right? Because of that session, which is the Asian session, doesn't have as much volume as the London session and New York session. So you will notice that the candles there at that time, they will be moving, but their range is usually a certain way. It's usually not as large. The range of those candles at that time is not as large as it would be during the New York session, during the London session. And then now in the morning, 8 a.m., 9 a.m., London session opens, you start to see candles moving differently. You start to see that the structures that were formed at night begin to get broken in the morning. So at that time now, that's what he's saying when he says market volatility and momentum. So market structure now is telling you, is showing you that this previous range is being broken. Why? The previous range is being broken, which means there's new volatility in the market. There's new momentum in the market. And so what you want to do now is, since the market structure is telling you that there's new volatility in the market, that there is new momentum in the market, you want to begin to go in the direction of new momentum, because the money flow in the market is depicted by the momentum and the volatility. The volatility and the momentum in the market is determined by the money flow, which means that if the market is selling, you will most likely see that depicted by massive sell candles. By the time you start seeing massive, huge sell candles, you see on the 4-hour, one massive, huge candle sell, you know that very likely price is going to continue selling for some time. You see, so that movement in the market now is giving you an idea of where the direction of volatility and the direction of the momentum currently. And that momentum you are seeing may last for a couple of hours or may last for a day, or last for some time. And then before it starts to reverse again. So market structure tells you all of that, tells you about short-term trends, long-term trends, market volatility, and momentum. All of this is what market structure tells you. You see, so you can see what we are covering right now. You start to wonder, so what does market structure not cover? Market structure covers most things around analysis. That's why I said that every quality trader, every big trader understands the market. There's a reason why every big trader who is very profitable understands the market. I'm sure you know that already. That almost everybody you know makes a lot of money in trading. They seem to understand the market on their own. And that's because they understand this. And most traders trade off of this. You see, because it encompasses everything you'll be looking for. You see, we're talking about trend, we're talking about momentum, we're talking about volatility, all of that. We're talking support, resistance. We're talking about economic conditions, central banks, geopolitical, everything is captured within market structure analysis. Okay? So we're going to be doing a lot, and the analysis we're going to be doing that we've been doing basically, that we're going to be doing, we're going to be having sessions like this where we'll just do market analysis. Now, when you understand this, that's when you can follow those analyses and do them too on your own. We can come now and say, okay, we want to analyze GBP USD. We'll clear out the chart and we'll start to analyze it. We'll start to look at what's going on in GBP USD, or what's going on in Euro USD, what's going on in gold. What are we likely to do? Where are we likely to take this trade? All of that is very important when you understand all of that is easy for you to do when you understand market structure. And market structure is something you can use to analyze any kind of instruments, whether it's a currency like GBP USD, or is oil, crude oil, or you want to analyze NASDAQ, which is an index, or you want to analyze BTC. Any asset you want to analyze, you can analyze using market structure analysis, right? So analyzing chart patterns, head and shoulder, triangles, rectangles, all of that too fall within the ambit of market structure. You see? So you can see a head and shoulder forming. You can see a W pattern forming. There are some pairs now that whenever there's a W pattern, you know, whenever you see a left, now we're going to have a class where we'll talk about these patterns deeply, but I'm just referring to them. Some of you might have heard about them. Maybe you don't know much about them, but we're going to talk about them in more details, right? You can see a head and shoulder forming, or you can see a W pattern. You see one leg of a W, just the way you have W, right? Just the way you have the W. Let me show you guys something. Now, this is a W. This is the first leg of a W, right? Now, this is a W forming. Okay. So now you see this form. Once you see this, right? Once you see this, what you already know, market structure is telling you that this is likely going to follow. This is what you call a W pattern, right? You can see this left hand, you can see this and see that, then you already know, look at it here. This is a W pattern. This is what you call a double bottom. So you see a lot of confirmation. All of this is done for you by market structure, right? All of this is done for you. When you understand market structure, you will find out that you are able to define this. And you will see this all the time. It could be head and shoulder. Okay, we're going to talk about those patterns very clearly. I just wanted to show you that as an example, right? We have head and shoulder, we have M pattern. Just the way this is a W pattern, when you flip a W pattern up, what do you see? What do you find? You have an M pattern. That's another pattern. There's a head and shoulder pattern. There's an inverted head and shoulder pattern. all of that, when we take it and break it down, you will see that market structure helps you understand all of that, helps you analyze all of that and understand it very carefully. You see, you will see it forming ahead of time. Not that when it has formed already, you now look at it and say, oh, this is what happened. Oh, I should have bought there. No, market structure will help you see. Now, sometimes you may see this happening. Okay, sorry. Okay, this is. So you may see this happening. Let me do this and show you. So you may see this happening, and then you do not know at that time that you may not have seen it. That is a W. This forms here, this happened. Probably you've not seen that this is a W pattern, or you are not very conversant with it. But by the time this formation starts going up, you will see that this structure here gets broken out like this, and then you may have missed the trade from here, yet you still enter the trade from here, and you know that price is likely to come to this stock. You know that price is likely to come to this stock. So you can, sorry. So you know that price is likely to come to this stock because you can see what's going on. You can see that price got out of this place. Price is likely to come here. This move here could be 100 pips. You see, so we'll talk a lot in details about all this, but I just wanted to hint you guys on that, right? So what's the next thing? Analyzing chart patterns, head and shoulder, triangles, rectangles. Yes, it helps traders make informed decisions about entry points, exit points, position sizing, risk management. You see, now watch this. Watch this. When you're entering a buy trade from here, let's watch this now. Let's use this as an example. When you're entering a buy trade from here, look at this point right now. You're entering a buy trade from here, and your goal is to enter this trade and it goes up here, right? So look what it says here. It says it is crucial. It helps traders make informed decisions about entry and exit positions, points, position sizing, and risk management. So what I'm trying to show you now is this. Now you're entering a trade around here, right, for a buy. What that tells you now is that you can see that your stop loss is going to be under here. How do you know your stop loss is going to be under here? Because the structure, market structure has already told you that price is very likely going all this way. That doesn't mean that sometimes you can't see what is called fake out, where price actually pulls down first. That doesn't mean it's not possible. But what it is that we have said before that you can't do analysis and get this market right 100% of the time. But you don't need, if you understand that you do not need to win 100% to be profitable, you would have been liberated in your mind. Because that's why some people feel that whenever a trade doesn't go their way, they think like, oh, something is wrong. Something is wrong because a trade didn't go my way. That's not the way the market works. That's not the way the market works. That's not the way investment generally works. All right. So when you know about a little thing, if you know something about venture capital investors, for example, what they do is that they can have 20 investments. They can have, let's say, $100,000 they want to invest in 20 investments. They will split it out 5,000, and they invest it. What they know is that if only one of those investments plays out, it will make them 10 times the money they invested in all of them. You see? So they are looking to make 200, 300, 500 times their money in that one investment or those two investments that do well. So that's the reason why we talk about risk management and risk to reward ratio. When you have your risk to reward ratio intact, then you can basically profit the way venture capital guys profit. Because they are looking for, they make 20 investments and they know that all I need to do is just let one or two of those investments play out. That's it. And when they play out, you will see the kind of money they make and everybody will start hearing about that one or two investment that they made that panned out well. Nobody hears about all the ones they threw money into that didn't work out. So that's the mindset also for you to have in trading. Understand that you don't have to win. In fact, in many cases, you can win 50% of the time and you are good. In fact, in some cases, if you have a very good risk to reward ratio, you can even win less than 50% of the time and you'll be massively profitable as well. You see? So don't bother about, oh, what if it doesn't go like this? It doesn't matter. It's part of the game. It's part of the game. What you have to understand is, how do I win within this game? That's the way it is, right? That's the way it is when it comes to investing. That's the way it is. So when you enter a trade here and you are buying, right, your stop loss is going to be under here. So you can see your risk, this is your risk from where you're entering this trade right now. From here, where you are entering this trade to this area, this is your risk. Now your reward is this piece right here. That's your potential reward. You see that massive move? That's your potential reward. You see? So market structure just showed you that. So market structure shows you where you are. That's why it says here, it helps make informed decisions about entry, exit, position sizing, risk management. So you already know where you want to enter the trade. You know where your stop loss is going to be. Then now you can use that to determine how much your risk management and your position sizing, which means you're trying to determine how much of your money you want to risk on that trade. Okay, if I want to risk 2% on this trade, how much? Then your position sizing becomes the next thing. How much is going to be my lot size? What is going to be my lot size? Now that I know I'm going to risk 2%, I have $1,000, for example. I want to risk 2%, which is $20 on that trade, right? And my goal, based on this risk to reward we are seeing, is going to be $60. I'm targeting to risk $20 to make $60. But then what's going to be my lot size? So this risk, which is $20, this risk, which is $20 is going to be what you will use to determine your lot size. Position size here means your lot size. Position size here means your lot size. So you use that to do. So you can see how risk management, you can see how market structure helps you determine everything about your trading. Helps you determine everything about your trading. Helps you determine your entry point, where you're going to enter. Why are you entering at this bottom? You can already see a pattern forming, because market structure showed you that. Where are you exiting? You are exiting most likely on top here, because you see that this is likely where price is going to go to. This is a W structure, and then the W structure is going to have to be complete. Okay, so it's likely going to go, your buy is likely going to go to where the sell came from. This sell, where this sell came from, is likely going to be where this buy is going to go to. So you determine that. You can see your exit. That's your potential exit right there, right? So next, the position sizing and risk management. So you can know where your stop loss is going to be, and then you know exactly what lot size to use. So the next thing is, it is crucial, it's a crucial component of technical analysis and used in conjunction with other tools, oscillators and indicators. Yes, so you can add indicators to your chart too. Indicators that give you an idea what's going on. So it just gives you a confirmation. It gives you a confirmation. Those oscillators and indicators give you confirmation as to what the market is already doing. Because indicators most of the time are lagging. They are called lagging indicators, because most indicators lag the market. And what that means is that they do not read the market very quickly. They will usually read the market when price has gone very far. You see, they will usually read the market when price has gone very far. And also, they don't have capacity to get it right. So you can be in a downtrend, and a particular indicator, RSI or stochastic, can be telling you to buy. It can be telling you, oh, price is overbought, price is oversold, start to buy. Price is oversold, start to buy. Meanwhile, you are in a downtrend. Market structure tells you that you are in a downtrend, but your indicator is telling you that it's time to buy. But remember, the indicator doesn't have, the indicator is like a thermometer, right? The indicator is like a thermometer. So the indicator will keep reading the temperature, but the thermometer does not have the capacity to know where the heat is coming from or the chill is coming from. You see, so what you want to know, first of all, what you want to focus more on before indicators is the market structure. So market structure is like what's turning on the heat or what's turning on the cold. Okay, so if an environment is getting very hot and the thermometer is there, the thermometer will show you that the heat is rising, temperature is rising in this room, but the thermometer does not have capacity to show you what is causing the heat. But then something else can show you what is causing the heat. You can hear a fire alarm showing you, oh, there's actually a fire coming, something, right? So what you want to do is you want to focus on what gives you the real indication before you follow indicators. So market structure is what tells you what is turning on the heat. Market structure is telling you what is going on, what is really going on in the market. Then you now use indicator as confirmation in the case that you need it. It's only when you need an indicator that you then use an indicator. If you don't need it, you just let it go, right? And whenever it's misleading for you, you know also that it's misleading. You don't just use an indicator blindly, right? So market structure shows you how to actually see the market for what it is. See the market for what it is, okay? So let's get into the chart and check up a few things. So I hope we are following this. We're going to have some time to ask a few questions soon. This class is basically the practical session of this class. We are going to continue it on our next class, but we'll just start it today. Okay, we'll start it today. We have to go through, first of all, to understand the charts, understand the theoretical part of this before we go on into the practical side of things. So now this is a CAD JPY chart, right? This is a CAD JPY chart. This is a CAD JPY chart. Okay, so let's see what is going on this chart. We said market structure shows us what's happening on the chart. What is going on this chart, for example? So that's the question we ask ourselves when we come onto a chart. What is going on these charts? Okay, you're welcome, Janet. The class is actually being recorded, so you'll be able to have access to it once we are done, right? So you're welcome. So now what we ask ourselves basically is what is happening on the charts when we come on the charts? And that's the question we want to understand by understanding market structure. That's the question we want to ask. What is going on this chart? And therefore, what am I going to do because of that? What am I going to do because of that, right? So first and foremost, when we come on the chart, what we want to do is we want to identify supply and demand zones. We want to identify supply, support, resistance, trends. You see, that's what we tell us where we should be buying or selling. Okay, so let's do that. Let me write something there. Okay, so when we come into a chart, so we want to first of all identify support and resistance, otherwise known as demand and supply. Demand and supply, that's the first thing we want to identify, right? So these are some of the first things we want to identify. Number two, we want to identify the trend. In fact, trend is probably what you want to identify first. You want to identify the trend first. In fact, it's actually in that order. You want to identify a trend first, then you go to supply and support resistance. You go to supply, support and resistance. And then before you start asking yourself, so where is the entry going to be? Where is the entry going to be? So this is actually, let's do this now. Okay, so the first thing we do, I want to write it in the order in which we should do this. First thing is we identify the trend. Number two, we go into, we want to find out where is support and resistance. where is support and resistance. So this is how we identify, this is what we do when we come on the chart. We want to first of all check what is the trend. Number two, where is our entry going to be? So if we identify a sell, and identify we're in a downtrend, we know that what we are supposed to be doing in a downtrend is what? Is selling. We are supposed to be selling in a downtrend. If it's in an uptrend, we know that we are meant to be buying in an uptrend, right? So we are meant to be buying in an uptrend. And then if we are in a sideways trend, we know that significantly what we need to be doing in a sideways trend is waiting. We want to wait to make sure that we see a breakout before we enter that trade. Except we want to scalp. And even when you want to scalp, it's always best to scalp in a proper way. Except you want to take 2 or 3 pips. And 2 or 3 pips is not good for your trading. The reason why 2 or 3, 5 pips is not good for your trading, because it gives you very poor risk to reward ratio. Risk to reward ratio. Because, for example, when you're entering any trade, you have to think about the risk first. Now, if you're going to take profit of 5 pips, what is therefore going to be your risk on that trade? What is your stop loss? If you were to enter that trade properly and do a stop loss, what would be your stop loss on a trade where you're targeting 5 pips as take profit? Is your stop loss 5 pips too? Right? Most of the time, it's probably not so. You're just entering and you're getting out quickly, right? So the first thing before you look at what am I going to trade, where am I going to enter the trade, is identify trends. When you've identified a trend, you see that we're in a downtrend. You're asking yourself, okay, now that we're in a downtrend, what am I going to do? Where am I going to be entering? Right? So let's look at this. Let's look at this. Let's start from this area. We don't have much time on this. We are going to continue this practical side of this class. Okay, so let's look at this area right now. Okay, this looks very much like a downtrend, right? Why is it a downtrend? Someone says it's a downtrend because it's coming down. Well, that's partially true, right? So, but then as a technical trader, that understands the market, it is not just a downtrend because it's coming down. It's a downtrend because it's giving us the qualities of a downtrend. It's giving us the qualities of a downtrend. Of course, visually we can see that as a downtrend, but in some cases, if we're looking at a chart from a longer time frame or even a shorter time frame, we may not be able to see that this is a downtrend and uptrend. Because, for example, you could come here now in a 1 hour chart and you see a bigger thing, and then you can see top to bottom, right? But when you go on the smaller time frame and you're looking to trade maybe on the 5 minutes, some people do some analysis or look to take trades on a 5-minute chart. When you come to that chart, you might not see what you are seeing here. So what's more important in identifying trends is to look at the qualities of a downtrend or the qualities of an uptrend, just like here too now. Right? Look at this. So you want to look at what is the quality of an uptrend, what is the quality of a downtrend. And that will also show you when a downtrend ends, when a downtrend ends or when an uptrend ends. Okay, so here we are seeing from the classes we've had before, we defined an uptrend and a downtrend. We talked about the qualities of a downtrend and an uptrend. We said a downtrend is an uptrend is a series of higher highs and higher lows. A series of higher highs and higher lows, right? We defined it, we talked about it in depth. So if you've not had that class, it's probably posted in the group. If you are new to the group, I think I'll probably post the classes again so that you can go through them. We had in-depth classes on that already, right? So a series of higher highs and higher lows is what we defined as an uptrend, while a downtrend is a series of lower lows and lower highs. A series of lower lows and lower highs is what we call a downtrend. Now, the reason why that's important, that definition and understanding of that definition is important, is because it also helps you understand market structure. It helps you to also know where to use market structure. Because those higher highs and higher lows, lower highs and lower lows we're talking about are structure points. Those are the points of entry when you are entering the market. Those are the points of entry when you are going into the market, right? So it's important to define them like that. All right, so we just have a few minutes left. I think what we're going to do, we're going to stop this class here, and then we are going to take this class into the practical side on the next class. Okay, we'll take this class into the practical side on our next class because we don't have much time right now, so we can't really do much. If we start now, we can't really do much. All right, so I'll give this time to ask questions. Let's answer a few questions. Then we will take this practical class into the next class. Okay, so I'm sure that will serve us better. We'll be able to do better with that. All right, so I'll stop the recording of this class now. Then I will ask a few questions. Okay.